It's certainly a truism, I think, but for us it's not really a big consideration. Our first and foremost concern is preservation of capital. I think Warren Buffett has often been quoted as saying that the first rule of investing is don't lose money, and the second rule of investing is don't forget rule number one. So, our focus is always to go out there and find these good quality companies that are trading cheaply. So if we're able to identify a business or an asset worth $1 trading at 50 cents, then we're not so concerned about what the share price might do in the interim. We're not so concerned about that opportunity cost, because even if share prices go up or down, to us, risk is not really about a share price going up and down. It's about the risk of loss of capital. And so when you can identify these good quality companies, and you can buy them cheaply, and that of course is key, you don't have to worry so much about what the broader market is doing. And to answer the question really about opportunity cost, we often get asked, do you wish you invested in company ABC? One that came up a lot was Afterpay. And while I wish the best of luck to people who have invested in it, and I hope that they do exceptionally well in these sorts of companies, our view is if we can't find some special piece of information, if we can't find some advantage that the broader market isn't paying attention to, then for us, it's just not a risk we'd like to take. So, these share prices might do exceptionally well, but we are comfortable letting these ideas go and recognizing the limitations of our time and our area of expertise, and really just focusing on those ideas that are most attractive to us that we can get really, really comfortable in owning. Look, it's a question that comes up regularly in the office. We'll take a position, it'll do really well, and then we have to sit down and have the conversation. What do we think this thing is actually worth? Because at some point, as the stock goes up, you need to decide, are we now speculating on some macro event coming in to make it intrinsic, to make its intrinsic value worth more? Are we relying on the markets to get overly exuberant about the idea and so push the share price up higher? And so at the point that we identify that we're now speculating on an idea, rather than having the information and recognizing that it is fundamentally cheap, that's the point at which we'll say, okay, time to sell down our position. And, often it works wonderfully. After we sell a stock, it goes down. Normally, our selling does nothing to the markets. And, most recently, when we sold down a big uranium position, which we've held since, I think, 2017. In fact, I think one of the first conversations I had about uranium was with you people at Livewire. And we finally decided about a month ago that the share price had got to what we thought. We were using a contracting price of about $70 per pound, and that price, using Paladin as a proxy, we thought it was worth about 55 cents per share. So it got to about 55 cents per share. We sat down, we said, look, are we prepared to speculate on spot prices going even higher, or are we going to take our money off the table given that we've gotten what we wanted? So we decided, take our money off the table, sold at between 52 and 55 cents. And of course, literally within the next week, maybe 10 days, it got to $1. So, sometimes you sell, things go down. Sometimes you sell things, nothing happens. Sometimes you sell and prices go up. But you can't worry about what the broader market is doing. Our job at least is to invest in ideas where we've got that information advantage, and we can point to the point that the market is missing, and explain that that's why there is value in this investment. At the point that we can no longer point to why it is that this thing is of value and why this thing makes sense as an investment, then we have to recognize that it's speculation. And again, there's nothing wrong with speculating. Plenty of people have made tremendous fortunes out of speculating. That's just not our job, and it's not what we spend our time or focus on. I think we've seen markets go from a historic average price to earnings multiple of 14, 15 times to, not that long ago, I think it was at 22 times. I think we've come back a little bit as earnings have caught up. But I think certainly money for nothing, as you put it, tends to push up asset prices. And so instead of finding ideas in all different regions within the market, I think what we're finding now is most of our ideas are coming outside of the most heavily coveraged ideas, because those heavily covered ideas are going to be where money tends to flow more easily and so push up share prices. Or in sectors that are out of favor, even immensely out of favor. So, we've found a lot of ideas in mid caps and small caps that have enough volume for us to get in and out of. And we've found some wonderful ideas recently in what we're calling sectors that are ESG pariahs. So, we're happy to look wherever we can find these opportunities. And I think our view in the office, at least, as it relates to ESG, is that the governance is of utmost importance. But just looking at uranium as an example, the ethical perception of things can change on a whim. There are certain things that we wouldn't invest in because they're bad for the world, and that's ultimately going to come back and impact the share prices. But, if we can find something that is unloved for an emotive reason, and it's not based fundamentally in the earnings ability of that company going forwards, then we'd happily invest in it. And, uranium was a great example in 2017. More recently, we invested in Beach Energy, which has done exceptionally well since we bought it. But that's where we tend to find the ideas in expensive markets, in areas that everyone is ignoring, or in companies that are sort of flying under the radar.